Hi, on today's Money Not Math conversation, we're going to talk about the markets. Specifically, I'll use the Dow Jones Industrial Average as the example, and ask the question, is the market comeback a reality, or is it a false sense of security before an election year and that could force it to correct itself, or other political things like that? Before we get into that, it's interesting. I know there's a lot of emotions going around right now. With the George Floyd death and the protests and the riots and like that. I don't want to get into the politics of it all or the emotions of it all. I just want to say I wish all of you that are affected by this, which is pretty much everyone from an emotional standpoint, but from a logistical standpoint, I wish you and your families and your friends good health, and I hope everyone can stay safe. So getting into it, I can't say that enough times, but I don't think anyone wants to come on here to listen to me repeat myself. But I hope we can, have progress together, and people can stay safe as possible going forward. So going back to the stock market conversation, I'm going to pull up an example here. I did a conversation a couple weeks back on the perception. Our perception is our reality. So let me share. Oh, forgot to share my screen here. Let me see here. Share screen. It's like my first time doing this or something. All right, so I'm sharing my screen. All right, so if you just Google the Dow Jones Industrial Average is going to pop up. It's one of the primary things you're going to hear about when it comes to the market, right? And it's the news media love to reference the Dow Jones and what it's doing on a daily basis. So today it's up 125 points, which is 0.49%. Small thing of warning, anytime you hear the news media use the percentage points it's up, that really doesn't mean a whole lot. The percentage is a lot more of an important number because that's actually the percentage of growth based off of the overall value, not just an arbitrary number of points. So going back to what I briefly talked about before was how our perception is our reality. So in today, the market's up, and even in today, you can see how volatile the market is. Now, if you look at the last 5 days, it's down, it's up, it's down, it's up, and so on and so forth. If you look at the last month, it's mostly up with some downs in there. Now, if you look at the last 6 months, yeah, it's not so fun, right? So this is where we see COVID-19 hits us, the government shuts down our economy, businesses are struggling, there's uncertainty. And what do we know about the stock market? We know that we have, unless you're one of those billionaires out there making trades or Warren Buffett, you essentially have no control over the market. So all of your money in the market is completely dependent on other people's emotions, politics, tax changes, things like that, right? So we really have very little control. So it's really important for us to understand that it went down, and now it has been slowly but steadily coming back up. And now with the riots and the stuff like that going, there's even going to be, COVID-19 shut down a bunch of businesses, and from a cash flow standpoint, our country, in my personal opinion, has been kind of falsely inflated from a health standpoint by all the stimulus packages. But someday those stimulus packages are going to end, right? We're not in a socialist country, at least some people would want us to be, but we're not there yet, and hopefully we'll never will be from my personal perspective. But once those stimulus packages end and everyone has to go back to living a relatively normal life, how many jobs are going to be still available for people to go back to? How many businesses are ever going to open their doors again? And how many of those businesses that would have opened their doors won't now because of the riots and looting, right? So what does that mean? I don't know. I can't predict the market, but does it mean that there might be another correction in store? I can't prove anything. I'm not going to try and make a guess, but I will say where it worries me is I was part of a conversation a week or two ago with a Minnesota Chamber of Commerce representative. And she said Governor Walz is great at asking for input. So I asked her, when it comes to the current recovery from COVID-19, I appreciate he takes input. I don't know how much he applies it, but at least he's asking for it. Have they started discussions around the recovery after the recovery? Meaning, how are we going to get our economy to recover after we have people go back to work, after the stimulus packages are done, after we have to create wealth for ourselves? It's not going to be just sent to us in the mail or via direct deposit. And what worried me was she said no. They're so focused on the short term, next days and weeks with what's going on and trying to get life back to normal. There really haven't been much discussion with the long-term plan of getting our economy back up and running. So what that tells me is it's quite possible that all of the gains we've had since, let's say, it looks like March 23rd was the low point, could be wiped out again. Now, they might not be, they might go up, they might go down. I don't know, but it's important for us to be understanding that it's possible that the recovery after the recovery could create another market correction. But let's say everything is just peachy. Life goes great, the market continues to go, everyone has money, everyone continues investing in the market. Well, on the flip side of that, we have to understand that the government just basically printed $6 trillion to send out to people, whether that's via loans or via stimulus packages, via whatever these different programs, right? And they kind of had to do it, right? Because they shut us down. They kind of had to help us stay afloat. What we have to understand about that is one, the more money the government prints, the faster inflation happens, which means the money we have today is worth less in the future, right? The second thing that happens is our government goes further in debt. All right, so let me come back here. I kind of got ahead of myself here or there, but let's just pull up the debt clock real quick. U.S. national debt clock. All right, and for those of you listening to the podcast, I apologize. I will use some numbers. I'll say the numbers, but I recommend finding the video if you want more details. The U.S. national debt today is $25.7 trillion. Okay, $25.7 trillion. If you go back before COVID-19, it was like 23.8-ish. Don't quote me on that. I don't remember exactly, but it was below 24. So in like a matter of 2 months, our country has gone $2 trillion about more in debt. And we'll see what happens going forward because as we know, the U.S. federal budget deficit went up. The interest on the debt's going to only accumulate. Our GDP is probably going down in this year. So if you just look back to 2016, that's 4 years ago, our U.S. national debt was $19.6 trillion. All right. Now, if you go back 2012, our U.S. national debt was $15.3 trillion. So as we can see, it's kind of accumulating. So what does that mean? Well, let's say the markets, today, the average, I'll just pull it up so I'm not wrong here, but U.S. Average income tax rate. I don't want to be called out for being way off here, so I'll just use whatever comes up. So let's say it says this is not up to date, it's 2017, but let's say the average income tax rate is 24%. Okay, well, if you have, let's say, $1 million in tax deferred accounts minus 24% in income taxes in retirement, what you really have is, well, I can't spell, so I'm just going to use this. Retirement is, well, if we do the math, $760,000, right? So $1 million, you can use your calculator if you want to make sure I'm accurate here, times 0.6 is equal to $760,000. That's, just to be clear, that's what's actually yours, is yours. $240,000, it belongs to the IRS using the 24% number. Now, let's say the markets are great and continue to grow. And we'll go over here and let's just say your $1 million over the next, I know I'm jumping around here, so hopefully it's loading well for you. But I think it's important that I show you what I'm doing, not just make you assume that I'm doing things correctly. Let's say your $1 million. Oh, The internet just decided to freeze on me. Grows for the next 10 years, grows at an average of 5%. Now you're going to have about $1.6 million. That's great, right? Your money grew. Let me get the font bigger here so you can see it easier. Awesome. Your money almost doubled over those 10 years without even counting future contributions. However, what if, with all of these political and economical decisions being made and the fact that our government's almost $26 trillion in debt, what if certain people get into office or certain Congress people decide to raise our taxes and they almost double? Well, or they even could double, right? You hear numbers as high as 70% income taxes thrown around. So let's just say they double. If income taxes double to 48% on average, $1.6 million, or we'll use the $1.628 million in tax deferred accounts is equal to, all right, so we're going to go 1.628 million times 0.62 equal to, please correct my math if I do it wrong here, 628,894.63 times 0.62 equals 1,009,914.67. All right, I actually use the exact number here. So $1,628,894.63. Oh, there's my alarm. Times 0.62, because we're taking away 48% in taxes, means that $1,009,914 is yours, and, well, we could just subtract it out. And $618,979.96 belongs to the IRS. So even though your money grew by 5% each year consistently for the next 10 years, in reality, how much of your money actually grew? How much of your money do you actually get to keep? Right? So we have to understand that even if the markets do continue to go up, if your money is invested in tax deferred accounts, it can make a tremendous, tremendous difference to how much of your spendable wealth you actually have in retirement. So it's extremely important that when you plan for your future, you not only take into account how you invest from a growth perspective, it's important you take into account how you invest from a spending perspective in retirement, how your money will be spent, and how you can use it. And it's also important to take into account how future tax changes could put negatively, maybe even positively, if taxes ever go down again, but more than likely negatively affect your money. All right, so hopefully today's conversation was helpful for you. I know I jumped around a little bit and had some lag due to my internet connection, but like I said, it's extremely important for us to understand our perception is our reality. The market correction that happened could happen again, whether it's in the next few months or the next few years. So ask yourself, how are you planning for your financial future to both grow and protect your wealth from market volatility and future tax changes? All right. Thank you for your time today. I hope you enjoyed our conversation and hope you have a great rest of your day. I wish both you, your family, your friends, and your loved ones health and safety during these chaotic times in our country. I'll talk to you later and hope you have a great day. Bye.